Well, it's a bull market, and there's gobs of breath, and that's always a good thing when you have advanced decline statistics that are coming in as strongly as we've been seeing them since the December 24th low. And so don't make any mistake of thinking this is not a bull market. It definitely is. And when you have a very strong advanced decline line, what that says is that there is so much money that's banging on the door of the stock exchange, all trying to get in, that it's even flowing into the least deserving stocks, all the little tiny ones. And that's what drives up the advanced decline line. That kind of condition tends to persist for a long time. Only when you start to see the advanced decline line slow down and make divergences versus the major averages do you have a big problem.
So you are looking for a bit of a slog here going into basically the first week of March. What leads you to that conclusion, and then why do you think we rebound from there?
Well, we've had a nice run. Don't make any mistake about the nice run that we've had off of that December 24th low. When you have a surge like that, it's normal to stop and rest. Everybody catches their breath again. It's normal also in late February to the first week of March that you have a little seasonal soft spot. I wouldn't even call it a decline, just a pause, just a little ledge. And then March, April, May, we get back to the normal seasonal strength, and the strong breadth numbers that we're seeing say that's when we should expect another wave upward. It's going to last for a long time. I'm seeing this uptrend from our long-term models lasting into 2021, and then a big long flat spot until 2024. The only risk of a real 2008 style bear market doesn't even come around again until 2024. So we've got a long time to go to make some money on the upside before then.
So, Tom, that's 3-year bull market then. Is that US only, or is it global? And equities looking attractive everywhere?
Well, the rest of the world is not looking as attractive as the US. We are leading the way, and others are going to tag along. If you look at any major world stock market average compared to the US, they're going to dance together like Fred and Ginger, but one may dance higher and faster than the other one, but the dance steps will be the same. I can't really extrapolate U.S. breadth numbers to any specific other country, but the changes that we've made in terms of taxes and regulations in the U.S. give us a big advantage that we didn't used to have a couple of years ago.
Tom, what I find so amazing about this forecast that you just laid out that stretches 5 years is we've got a presidential election in the middle of it. Obviously, lots of question marks longer term about Fed policy and other central bank policy, all of these trade talks that continue with different countries. Would any of that change that forecast?
Well, sure. An asteroid could hit and knock the Earth off its axis. There's lots of risks of things that we don't know about, events that haven't happened yet that could disrupt the whole schedule. But there's a lot of things that are put into the tape as it goes across the chart already. One of the things that we've discovered is that for about the last 120 years, the price of crude oil will lead the stock market by about 10 years. So when you see a big bubble top in crude oil in 1920, about 10 years later, you get a big bubble top in the stock market in late 1929. So that's part of what the long-term forecast is that says, hey, look out in 2024. That'll be the 10-year anniversary of the giant oil price slide that we saw in 2014. But we don't have to worry about that for a while. Right now, we're still riding the rebound of oil prices from 2009's low, and that should be lasting us for a while into 2021.